Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Mathew. This show gets you actionable insight on everything personal finance related, and we're talking about the big bang announcement from last week, in fact Friday, where the Reserve Bank of India cut the interest rate by 50 basis points. What does that mean? Well, it means that all new loans that are issued now, that are given out right now, will be about 0.5% less expensive than they were just last week, which means that if you were to go out and get a home loan today, last week it would have been offered to you at about 8.8 or thereabouts. It would come down to 8.3 now. And of course, that's just an example. Let's see how this works. We will also talk about deposits. Fixed deposits, just like loans, will be repriced because rates across the board will go down. What does that mean for you? If you've got fixed deposits that are maturing in the next 3 to 6 months, that means that you have to plan your investments to take advantage of whatever you can to ensure that you don't get the raw end of the deal. Joining me today is Nikhil Kothari, who is director at Etika Wealth, and I've also got Varun Fatehpuria, who's the founder and chief executive officer of Daulat Wealth Management, joining me today. Gentlemen, thanks so much for taking the time. Nikhil, I'll start with you, and let's talk about this loan bit first, right? I think the first and most important thing to understand is whether you are on a benchmark-linked loan or a marginal cost of funds lending rate-based loan. Can we take our viewers through that first?
Okay, so first there are two types of when you take a loan from the bank. There can be floating rate and there can be fixed rate.
Right.
Fixed rate is very simple, that fixed interest throughout the tenure, right? But most of the people, when they take a home loan, they normally take a floating rate home loan. Now, floating rate home loan, now bank offers two types of instrument. One is called as benchmark linked rate, and one is called as MCLR. Now, what is benchmark linked rate is basically they are linked to repo rate, right? So as soon as the repo rate is deducted, right, your lending rate also comes down, and which also will work vice versa. If the repo rate goes up, your lending rate immediately go up also. Okay, so that depends on the benchmark lending rate. There's an MCLR lending rate, which is the bank marginal lending rate, bank marginal rates, where they link the rate based on that their overall book size. Now here the pass on happens slightly delayed. So if the rate has been deducted by RBI immediately, right, it will take, say, 3 months to 6 months time to have an effect on your lending rate. And same goes when the rate goes up also. It takes quite a little bit longer time to reflect on your lending rate. So now it depends on which rate of which type of lending rate instrument you have taken, your rate will be reflected accordingly. Except, for example, if someone has taken a benchmark lending rate, his interest cost would have been reduced from today onwards, and then he has to pay either a lower EMI or he can reduce the tenure by keeping the same EMI.
Okay, so we'll talk about that in a bit. By the way, if you've got an existing loan that is on the external benchmark linked rate, then it takes a month. There's a reset every month. So that's when your lower rate comes into play. I was speaking with Punjab National Bank's chief executive officer earlier today, gentlemen, and what he was pointing out was for his book, for his retail book, about half of them or half of that loan book is still either MCLR or marginal cost of funds lending rate or base rate. So which means that a lot of people with older loans are still on that MCLR, which means that it's going to take a little while for their loans to reflect that change in interest rates for them to take the benefit of the lower rates in the system. So the question to you, Varun, is if you are on the marginal cost of funds lending rate, which means that you have a home loan running or a larger or a longer loan, should you make the switch to EBLR?
So, hi, Alex. As both of you pointed out, MCLR is an internal calculation which the financial institutions, banks, NBFCs, microfinance institutions use to calculate what their marginal cost of fund is and add a spread over and above that to come at the cost of fund at which they are going to lend to their borrowers, right? So naturally, since the per location of any changes in the policy repo rate takes a certain amount of time to reflect that in the bank's book. Hence, the banks typically have a lag between when the repo rate decision is announced and when the calculation for their MCLR is done, right? since 2019, actually, RBI has mandated that all new loans, whether that's personal loans, retail loans, or MSME loans, needs to be linked to the external benchmark-based lending rate, which in all likelihood ends up being the policy repo rate, right? The rate at which Reserve Bank of India lends to these financial institutions. So yes, it is always in the benefit of the borrower to have their today any of the existing loans also to get it linked to the EBLR, primarily due to a swift transmission of any changes in the policy repo rate typically ends up happening within the next couple of months, depending on what the reset is. So, in a declining interest rate environment, you stand to benefit almost immediately as and when the policy repo rate gets cut. But also on the opposite, I think when we are in a more tightening cycle, then your cost of borrowing also increases.
Okay.
So that is what we would advise the borrowers.
Okay, and I know that Nikhil did mention the fixed rate loan, and as I understand it, Varun, a lot of banks don't offer this upfront, right? So while it exists, there are conditionalities associated, and it's also pricier. Am I mistaken, or is that the case?
No, that's absolutely correct. So without getting into the technicalities of how banks actually manage their book, there is something called as an asset liability mismatch. So typically they would like to price their loans in and around where they have the maximum demand, and accordingly the deposits also get priced accordingly. So let's say if we are into a product, something like a home loan, which is a 10 15, 20 or 25-year product, it is really difficult for banks to price what the loans would be and what the movement of the interest rate would be over a period of a couple of decades, right? So for shorter tenure loans, let's say something like a car loan, there you could have a fixed price loan. But anything that goes beyond that 7-year, 10-year period, their banks also have more comfort to, offer you a floating rate loan. So yes, there in theory, there exists a fixed rate loan, but for all practical intents and purposes, the outstanding percentage of any personal retail borrower who could go and borrow a fixed rate loan, at least on the home loan side or for that matter, an equivalent would be quite small.
Okay, and I'm glad that we have that clarification. Now, when it comes to repaying of the loan, and let's assume for all practical purposes that the transmission takes place relatively quickly, the question is between prepaying, that is getting rid of your home loan quickly, or letting it go on. Now, when it comes to the tax advantages of having a home loan, this is fairly understood by a lot of people, especially those that have home loans. When it was old tax regime, a lot of people benefited from that 2 lakh deduction under Section 24, where you had your interest payments on a home loan deductible by each individual. So if a couple was paying for a home loan, which they both owned together, then they could claim a total possibly of 4 lakh rupees, which was quite considerable. But since a lot of people have moved to the new tax regime, Nikhil, the question is, does it still make sense to not prepay your home loan, that is to continue to pay basis the schedule?
Okay, so practically, if I look at, so I'll give you one of my friend's example, right? He has a loan with external benchmark lending rate, and yesterday, with the repo rate change and with the new month coming in, his rate has now been reduced to 7.75%. Now, let's take a practical example that at 7.75%, what should I do? Okay, now if we belong to old tax bracket, then old tax regime, then the effective rate is only 5.4%. So in that practical sense, it doesn't make sense to prepay the home loan because he get a tax benefit. Rather, he can invest that money, whatever he has, and over long period of time, if he has a risk appetite, he can make far better than 5.4% return, which is effectively paying for the home loan. Okay, if someone has given the property on rent also, right, and he has taken a home loan, then also it practically makes sense not to repay, because the interest which you, the rent which you get and the interest which you pay on home loan can be set off against that. So that income doesn't add to your overall income, and then you don't pay tax on that. So for people who are belong to old tax regime, as well as the giving property and rent, I'll say home loan is a good loan. And at the current rate, it effectively makes sense not to prepay the home loan if you have a slightly risk appetite and hold for, and you have a tenure of 5-7 years. So you can invest in other instrument where you can make more than 5.4%, 5.5%. Now, for people who belong to new tax regime, now again, the rate which you're paying right now is 7.75 to 8%. Now, if I take a 10-year picture and someone has a horizon for 7 to 10 years, then I'll say that, and if someone has a risk appetite, I'll still recommend that investing in a hybrid fund or equity fund can give you more than 7.5-8% return over a long period of time. So if practically, I'll say that right now, and it gives you liquidity also. So if practically, I'll say that if someone has a risk appetite and a long-term horizon, he can invest he can invest the money in financial instruments and can continue with the home loan because the rates are low right now and it may come down further incrementally.
Okay.
Right? But someone with a risk appetite and wants to clearly and fall into new tax regime, he can prepay the home loan.
Okay, that's an interesting point. And just so you're absolutely clear, the question that we're asking is, since the interest rates have dropped by a percentage point, and most of you will see that reflecting if you have an external benchmark-linked home loan, should you continue to prepay if that's something that you've done, or take advantage of the lower rates? Varun, you want to add to this? What Nikhil is suggesting is that what you would have used to prepay, if you invest that instead, you might be better off, if I've understood that correctly. Nikhil, that's what you're saying, right? Okay. Varun, you want to weigh in on this?
No, just allude that obviously, let's say if you get to the actual hard numbers and math, I think home loan continues to be a beautiful product, right? Not just because of the tax benefits that you get under the old tax regime, right? But the cost itself is one of the cheapest loan that you could probably go out there and get. And the opportunity cost of prepaying that obviously is something where you could go and invest in the markets and gain a significantly higher rate of return. But just to add, I think one of our experiences has been that most of the borrowers, try to look beyond that and do not want that the tension, so to speak, of a loan hanging on their head. So sometimes, even despite the maths, sort of like adding up, that benefit of just living a loan-free life also tends to appeal to some of the people. But yes, I would sort of like just keeping with respect to the numbers, the things to add up.
Yeah, I mean, you have to differentiate between potential return in market-linked instruments, gentlemen, and what reason tells you, right? So there's no guarantee that you're going to get a 9+% return over the course of 10 years, even though history tells you that that's possible to get in a market-linked instrument. Nikhil, you want to say? Yeah.
Alex, the bench, but the what you say, the target right now is on 9% also, because the rates have come down and effective rates will come further. So I'm just giving an example of my friend. The effective rate right now is 7.75%, and most of the people won't be beyond 8%. So what you saying, your benchmark is also comes down, and with further rate reduction, right, it may come down to 7.5%. 7.5% to make over in financial instrument in a market-linked product over a 10-year period is very much doable. What I will always say.
So it's a strong argument to do that. If you've got the gumption to do it, this is something that you should consider doing. Now, the other aspect that I wanted to discuss is if you are going out to get a home loan now, it's a great time because according to a lot of people, Nikhil, the cut in monetary policy has already taken place. It's been front-loaded. There is unlikely to be too many cuts, if at all. Some people, of course, anticipating another 50 basis points. And while that could come about, even as things stand right now, it's pretty attractive to go and get a home loan because we might just be at the low end of the cycle. What do you need to know if you're planning to get a home loan right now?
So basically, again, first with even today, I'll say floating rate makes sense because there's a further chance of reduction in the rates. If you can speak to a bank that later, can I convert this floating rate to a fixed rate loan? So if rate comes down really by another 50 basis point or 100 basis point, right, in that range, then converting a fixed loan converting a floating to a fixed also makes sense because then you're after every 3-4 years, we may have a upward trajectory in the rate. There may be a possibility. So that's one way one can look at it. But I'll say it's a good time to go for a home loan depending on your requirement, right? And instead of putting a large sum of money only from your own capital, I'll say that you should take a home loan right now based on eligibility and enjoy the benefit of that.
Okay. Varun, to drive home this point, what is the quantum that should be paid as a lump sum, and what are maybe some of the thumb rules that you can suggest? Because a lot of people will have savings. Should you exhaust the savings that you've accumulated perhaps over the course of the last 5-7 years and make the decision to take advantage of the lower interest rates?
So let's say if I get your question correctly with respect to the LTV, so there are again hard norms which the RBI has prescribed and most of the financial institutions would follow depending on the tenure of the loan and the value of the property. So the LTV, which
By the way,
essentially means
LTV,
that,
yeah. Sorry, you were explaining loan to value.
yeah, the
Apologies.
loan to
Please
value
go ahead.
ratio, the loan to value ratio. So let's say if a property costs 100 rupees, the banks are only mandated to lend up to 75-80% of the value of the property, and the remaining 15 to 20% of the capital is something that you need to pay upfront as a form of equity into the property ownership, so that you have skin in the game. So these are basically hard rules which the RBI has mandated, beyond which the financial institutions would not be able to lend, to make sure that the borrower itself is not overly leveraged, number one. And number two, the borrower has the ability to pay a home loan which is going to continue for the next 15 years, 20 years, depending on what the credit assessment of the borrower is, basis is income and age, and the overall borrower profile, whether it is a single borrower or a joint borrower, and what the expenses look like typically on a month-to-month basis, whether the borrower has any existing obligations as well. So again, these are the parameters which these financial institutions would typically look at, conduct a very thorough study, and then come to the total quantum and the LTV, the loan to value ratio, which they are able to provide you.
That point is well made, but and I think a lot of people are aware of this 80-20 rule. But what I'm trying to get at is that just because the rule exists does not mean that you only pay 20%. If you can pay more, and if you have a sizable amount of corpus that you've saved up, you can borrow less, and thereby the interest cost that you pay is also significantly less. What I'm trying to ask is, should you remove from your long-term savings a certain amount of funds to pay that down payment, and how much should your EMI be? Because ultimately it's a product of what you choose to pay.
Correct. So let's say if I just look at a rule of thumb, right? Today, we typically advise clients and borrowers to have their EMI payments not more than 25 to 30% of their overall monthly income, right? So obviously, the higher the amount of loan that you go out and borrow, there is a very high likelihood that the number starts to sort of breach higher. So to be in a relatively more comfortable position, I think it's better that you keep that number anywhere between 20 to 30% of your total monthly disposable income. Even if that means, let's say, if you're able to afford taking a certain chunk of your money out of your overall long-term portfolio, if that helps in reducing that number down, then it is always better, because again, the opportunity cost, as we just talked about, could be higher instead of repaying every single penny of your income towards an EMI. I think that money and the cash flow could be diverted towards other, let's say, more market-linked instruments over a period of time. And there is a study where, let's say, if you have a 15-year, 20-year home loan product, right? If you do a certain percentage of that into an SIP, I think within 12, 13 years is something that you'll be able to repay that outstanding. Okay, so yes, that's the number that I would recommend.
Okay, 30%. But the harsh reality, Nikhil, in Mumbai is that in Mumbai in particular, and there are a few other markets like Mumbai as well, is that the property prices are so large that it's practically impossible to restrict that EMI payment to 30%. And so you are sometimes treading towards 45, 50%. It helps, of course, if you have a second contributor to that repayment, in which case you can pay a higher amount. But the question is, a lot of people argue that in the first 3 or 4 years, they stretch, and then as their income levels rise, they're more comfortable. Is that the right approach?
So first you have to combine both of your income, both husband and spouse income, right? So that based on that you should calculate the EMI, and as the income keeps on increasing, your the EMI remains same, so your burden keeps on coming down as a percentage of overall income. Now, since there's a corpus right now which is already there, right, which can be used if at times you have to stretch beyond a point. Right, so you can redeem that corpus at that point of time and pay for the EMIs or other stuff. So I'll say that right now you can limit both of your income to 35% of the overall disposable income, and if 35 to 38%, right, in the current context in terms of rates and everything. And since you have a long-term horizon, it makes sense to stretch that 35 to 40%. But yeah, you should have that buffer with you, so that tomorrow if there's any emergency or something, you should be able to withdraw from your long-term corpus and repay for that home loan. Right, and with the income increases, right, you should be able to manage that, but should not be beyond 35 to 38%, because beyond that you're stretching too much, and it can at times lead to financial stress in the family.
Yeah, absolutely. And this is a rule for all EMIs. Bear that in mind. We're not only saying home loan, and usually this is a chunky EMI payment, but it would preclude you, for example, from taking an EMI on a new phone, because that would push you over that 40% mark, and it would not necessarily be the most comfortable thing. But
Exactly that. Only when you stretch, you should only stretch for home loan and not for any other loan.
yes,
Because home loan is fruitful, because home loan you're creating an asset, but you're not creating asset from any other loan.
yeah.
Right? You're creating asset. And second thing is that the lowest, it's the lowest rate as compared to any other loan. The rates are very, very high, and you don't get any tax.
We've had a conversation about auto loans as well, and where you said very clearly that within the first year, if the value of the car is dropping by 25%, you bought, essentially you've taken a loan on a very expensive product which is depreciating very quickly. So we've spoken about the loan side of things. I also want to talk about the fixed deposit side of things, because ultimately this is what a lot of people earn their income from, particularly above a certain age. You are depending on these products because of the safety involved. Varun, the question is, reinvestment risk is the primary issue with fixed deposits, and that is coming to the fore right now. Over the next 3 to 6 months, if you have to reinvest, you're investing at a very low rate, 7% or thereabouts, if I'm not mistaken. How should you plan your investments in fixed deposit?
So obviously, I think the rates, jokingly, I think banks tend to cut the deposit rates immediately right after the policy repo rates are announced. So obviously, if you look at the trajectory of the fixed deposit rates over the last year, a 1-year general non-callable deposit, right, was anywhere between about 6.75 to 7% by most of the financial institutions, right, public sector, private sector banks. That has now come down sharply to about 6.5%. And it is only fair to assume that now, once the policy repo rate sort of perlocates through the entire financial system, that number could start inching down closer to 6% or even late fives, right? So obviously, I think that the reinvestment risk will continue to remain. People who had invested at a higher period or have their maturity of fixed deposits coming in the next 3 to 6 months, they will face this dilemma of what to do. Should I go and reinvest at a rate which is significantly lower? And this is a problem which is specifically, as you mentioned, is for retirees who are withdrawing regular income out of it. So the challenges always gets pronounced over there. Our suggestion is, yes, I mean, that is something that is a problem that you'll have to live with. But if you could slightly increase your risk appetite on your fixed income allocation, then there could be slightly better products in the mutual fund space. Let's say something like specific multi-asset allocation funds, or a new category of schemes like income plus arbitrage, or even conservative hybrid funds, where the percentage of debt exposure is anywhere between 65, 70, 75%. But we can see that they are able to control that downside better. So you could have that withdrawal rate. If you were withdrawing from your FD at 6, 7%, you could keep that withdrawal rate intact in that product itself, assuming that you want to stay invested for a longer period of time. But because over a period of time, that sort of evens out, even if there is some marginal drawdowns in the equity component of that product.
Okay, so you've spoken about arbitrage funds, you've spoken about multi-asset funds, and you've spoken about income plus arbitrage. And we've spoken about income plus arbitrage on this show as well. So I'd invite our viewers to have a look at that conversation. But Nikhil, a lot of people are uncomfortable with the idea of going into mutual funds in the first place, and then when you think of things like arbitrage funds, then they get even more frightened. So what is the advice? How would you suggest that people should approach this? What is the safety aspect? Is there a risk of loss of capital in any of these products?
Okay, so coming to the different categories. Now, arbitrage fund cannot be compared with an FD over a long period of time, because arbitrage fund is more about comparing with a liquid fund or a very, very short tenure money, right? That if you want to invest for 6 months, 1 year, 1.5 years, then you can look at arbitrage fund, but you should be able to, whenever you need the money, you can withdraw that money at any point of time. In arbitrage fund, there won't be any loss of capital if you invested for a reasonable 1 to 2 months time, but the return are not fixed here. Returns are volatile, and it depends on the market opportunity in terms of if there's volatility in the market, the returns are slightly higher. But and since the returns on debt fund comes down, the return arbitrage will also come down incrementally. What one should look at is that conservative hybrid fund, which has got like a 10 to 15% equity and remaining portion in debt. I think that portion is one can look at. Is the probability of negative return over a reasonable 2 to 3 year time frame? I'll say the probability is very, very low, because if you look at over a cycle, right, and because it's only got 10 to 15% equity, and even if there's a drawdown in equity, the debt component takes care of the return. So loss of principal looks very much limited in a conservative hybrid fund, which has got only 10 to 15% equity, but it gives you return kicker when equity market does good. And the good part is that the taxation. In most of this fund, the taxation is only 12.5% if you invest for more than 1 year. So if you belong to highest tax bracket, then this product makes far better sense as compared to the fixed deposit. Some can also look at slightly corporate fixed deposit that will give you slightly higher than your bank fixed deposit. And coming to now the bank fixed deposit, the rate has already come down to 6.6%. And with further rate reduction, as rightly said, that may come down to 6% or below 6%. So in that case, one has to look at slightly aggressive assets as compared to only fixed deposit. So one can look at corporate deposit or a conservative hybrid fund. Yeah. And if someone has a 3 to 5 year period, because he has to beat inflation.
Okay. Quick follow-up, conservative hybrid fund. What are the funds that you like, Nikhil? Not recommendations, but what have you identified that you like?
So in our case, when we look at conservative hybrid fund, we predominantly look at which has got a very low equity exposure. So we can look at ICICI Equity Savings Fund, which has only got 8 to 10% naked equity exposure, and we look at Franklin Equity Savings Fund, which has only got again 10 to 15% equity. So that it's very low on equity. It's primarily talks about arbitrage and debt. So from a risk profile perspective, the drawdowns will be very, very limited, and you get return in line with debt products, but with a lower taxation.
Okay, so we've had a pretty in-depth conversation, mostly about loans, but also to a certain extent about fixed deposits. By the way, if you've got any questions about how you should plan your investments, and we spoke about the alternatives to fixed deposits, do let us know in the comment section and we'll take it up on subsequent episodes. Nikhil as well as Varun, thanks so much for joining me on the program today. Pleasure having you.
Thank you, Alex.
All right, that brings us to the end of this edition of Your Money Matters. Like I said, let us know what you think and do stay tuned. This is NDTV Profit.